You don't wake up knowing markets, kid. Everybody starts brand new. First you learn what moves, what waits, and what risk can really do. No racing clocks, no magic tricks, no get rich overnight. Just learning how to place a trade and sleep cozy and tight. No shortcuts, no loud claims, just rules you understand. Know what you're risking, know your why. Keep a steady hand, one trade at a time, that's how it's done. Slow is smooth and smooth is smart. You learn before you earn, my friend, that's how confidence starts. This ain't a sprint, it's a longer game, so pull up a chair and plan. Welcome to Options for Beginners with Dan.
Happy Friday. Dan, how the heck are you? Are you staying warm? Are you safe?
Staying warm. A little cough here, but have the little sweatshirt on, a little cool in the basement here. I mean, I hope there, it's funny. In Chicago, as you talk about cold weather, the weathermen were always interesting. In the 70s, there was a guy by the name of John Coleman. It's like, weathermen, how do you get an audience? Because you're going to be wrong more than, it's like a spec trade. You're going to be wrong more than 50% of the time, probably.
Yes.
So what do you do? I mean, if you're in Boca Raton, if you're in Florida and you're a weatherman, why would they pay you?
Hurricanes. Those guys live for the, aside from that, what else are they doing?
You're right. But I mean, other than that, for a few hurricanes, you're saying, what's it tomorrow? 75.
Yeah.
Today, 70. Tomorrow,
sun will be out.
Yeah. But in Chicago, John Coleman figured out, all right, how do I get viewership? It's not about the weather. So he'd be doing like zany skits and, more comedy and stuff like that. So, but anyways, folks, here's what we got today. Two things we're going to go over today. And as always, sometimes you're okay, I'm going to do this. I was going to focus on deltas. I'll hold that off till next week. The most important Greek in the world, deltas. Delta Force is the most important in the military.
That's right.
Deltas are the most important, and we're going to delve into that Monday. But today, I got sidetracked, and why not blame Troy, right? Yes. I was out late driving late last night, so I didn't make the show today. And I heard Matt. It was a great show, but they were talking about Iran, and hey.
Yeah.
Going over the weekend, what's the possibility? And I thought, okay, this is a beginner show. What can we do that would be very cheap trade? And again, continue. To me, beginners, sometimes people think, okay, beginners start at the basics. What is this?
Yeah.
I get that. But to me, the way I learned in the pits, even at the beginner, repetition and just seeing it, right? If you want to be a mechanic, hang around the garage. Right? Hang around with the guys. You'll pick it up, right? You'll pick it, agree? I mean, you'll pick it up, you see it. And I think as you see trades and you hear people talk, I think beginner, it's not necessarily you have to dumb it down. You just go slower, right? And just more examples. So we're gonna start with building a little bit on what we did last week. Let's bring up, I'm gonna give you encouragement that if you wanted if let's just say we take this scenario, and we can maybe update you guys on, we're looking, okay, the scenario, the war games that they were playing in in the morning, the war games was, okay, if Iran, is that the key, Matt? If Iran.
I mean, there's just there's this geopolitical thing that, I mean, what Troy was positing was, is there a way to get downside exposure if there's a political event, a geo event over the weekend to Iran, in Iran, if there was, a little bit of a burp in the market, a little bit of a self, which we just had one right? That was this week, right? Yeah. Wasn't the market down 100 points on Monday? So, right now we're not that far from all-time high at 69.30. And yet, if we had 100-point or 200-point move on the weekend, Dan, what are some things that we could do?
So here's the thing. And I was thinking, you remember that song, girls just want to have fun. Remember that song? I don't know who made that song. It was.
Oh, I remember it. I don't know. I'm going to get the name
thinking,
wrong. I'm saying Cyndi Lauper, Blondie. I don't
Yeah,
think either of those are right.
so I'm just thinking beginners just want to have fun. So here's today. So let's start out with Matt. We're thinking as a beginner, I want to have something that has a reasonable shot at doing really well. Not a lot of money for the downside on Monday, geopolitical. So let's start with, we're going to do Build-A-Bear, folks.
Okay.
Start with buy one. We're going to go Friday. We're going to go to Monday. It's Monday. We're going for the homer.
So
Jan 26, 69.10 put.
Okay. 69.10 put. There we go. It's like $12.
Yeah. So let's model that.
Okay.
All right. So we look at that as a beginner and you say, Dan, won't work. And I say, why won't it work? And you say, Dan, $1,200. And we're buying the 69.10 strike.
Yeah.
We're currently at 69.27. If we don't go down or go up, I lose $1,200. Dan, I will shoot you in the foot. All right. So I say, okay, let me work with you. All right. So this long call has got 35 short deltas.
Now this is a long put. Is that what you wanted?
A long put. I'm sorry.
Yeah. Okay.
Long put, 35 short deltas. So it's saying, think in terms, just as a quick and easy definition, folks, think in terms of delta, kind of stock equivalent. If it goes down, you'll make 35. You'll if you're short 35 shares of stock, if it goes down $1, you'll make about $35. The problem with this thing, when you buy a put 3 days to expiration, always follow the biggest Greek in the block. And Vegas, but theta. So it's saying, hey, this thing is starting to decay the second you buy it.
That's right.
So that causes a lot of stress. We don't want to do that. So what we're going to do is say, okay, you know what? Matt, let's add a leg there and let's sell the 69.05 put. So the 69.10 put was how much we said?
It was over a little over $12.
$12. So we say, you know what, Dan, is there a way to play to the downside without whipping out $1,200? It's a beginner. Dan, you say beginners shouldn't be trading more than $200 to $500. All right, we got you. We're going to sell the 69.05 call.
Yep. So
now what was the 69.05? How much did we bring in there?
That was about $11.50 right now. And
all right.
So yeah, it's about a $1.30 for the whole spread.
All right. So from what we sold the short for versus the long, now instead of stressing all weekend about $1,200 of risk if we don't go down, now we brought it to 140. Now the beginner says, Dan, now you're talking my language.
Yeah.
Right? And the other thing a beginner might say is, you know what, Dan? Is this too far out of the money? Do we, as Marlon Brando said, I could have been a contender.
There it is.
Can this trade be a contender? And here's what I tell you. What's the delta, Matt, of the short put? We want this to go to the short. What's the short delta of the short put?
So the short put by itself, the delta is 31.8.
All right, so let's focus on that. So on this trade, let's look at the trade, the whole trade.
All right, let me add back in the long put.
Yes, sorry. Yeah, okay. So we're buying the 69.10, selling the 69.05. Yep. So this is saying, right?
Yep.
So this is saying at expiration, at the end of the day, Monday, if we're 69.05, where we are now, we're at 69.27, 69.05 or lower, we make how much, Matt?
$375. Because as we've been talking, people have seen delta in action and the price of the spread has changed a little bit. So,
but the point is, we paid $120.
Yeah.
If we finish at the short strike or lower,
that's right.
We're going to make, what's that, about 300% return, Matt?
Yes, sir. Very good math. Yep.
Yeah. So now somebody says, well, Dan, what's the probability of going down there? Well, the delta of the short put is about 30 or 31.
Yeah.
That means there's about a 30% probability. There's only a 30% probability we'll finish below the short strike.
Right.
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 But in reality, this is only, we're currently at 69.30. We're talking going down
Less,
20, no,
yeah, less than
25
1%.
points, right?
Yeah.
25 points. And if you look at, we haven't gone over this, but I'm going to say it so beginners should hang in there. The expected move for Monday is 42 points.
Wow.
We're saying there's a 68% probability we can be with up or down 42. So we're looking for 25 points down, and we're paying $1.20, right? But here's the key. Beginners, here's the thing, whether you're with a long put or a long put vertical debit spread, which this is, generally, are we going to, is the way most people do it is wait till expiration on a long put or a long put debit spread. No, I mean, I might look at it, hey, if I can get 30, 40, 50% or more, could be 100, or, you can kind of see how it works on Monday, but this is $120. Now, somebody will say to me, Dan, you know what? I don't get paid till next week.
Right.
I've got $30 on me. Can you work with me? Is there a way I can participate just to see how this stuff works? Is there a way I can participate on the downside and play in a $6,000, $7,000 vehicle like SPX for $30? And that it be realistic. It's not like something like Pluto. I said, right. Yes. You know what? It's tough, but let's give it a shot. So now we have a put vertical debit spread. Yep. So we add for a leg. We're going to add on top of a put vertical debit spread. We're just going to add a put vertical credit spread.
Okay.
With the short the same, right? As the short of the put vertical debit spread.
Okay.
And the long is going to be at 6,900.
So 5 wide.
5 wide. So now you say, wait a second. I can be in the major leagues. I can play an SPX on a $7,000 vehicle for about $10 to $20, right?
Yeah, $15.
$15. No. As we speak, I am going to, now it says $15. I'm going to put this on in a second. Let me actually do this trade. But the point is, now you're talking a lot of times people will say, well, you're going to play in SPY. If you're a beginner, go in the AAA or AA, play SPY.
Yeah.
You can play SPX. I mean, this literally, let me go in there and do this. 69.0, what's this? So I'm buying what are we selling? We're selling the 69.05 put.
Yep. 2 of those and buying a 69.10 and a 6,900.
Yeah.
That's how I have it set up right here, at least.
Yeah. And I'll tell you folks, what is a realistic, so mid-price, what are you showing, Matt?
Like $20.
All right. So so what I do, and again, let's talk execution, folks. You're saying Matt says the mid price is 20. If I wanted to try this paper or live, what would you do, Dan? Well, it's a debit transaction. Always start under. You can always pay up, right?
Mm-hmm.
You go to a car dealership, do you pay sticker? No, if you paid sticker, the guy would take you home and adopt you. Right? And say, you're my best friend. No, now it's $25 debit. Well, what I'm going to do right now is I'm trying to do it. I'm going in there and paying 15-cent debit. I'll see what happens. All right. I paid 15 cents. The salesman in there said, good luck to you, son.
Yeah.
Right. So now I go up to, because I want to just see what fair value is.
Yep.
It's a debit transaction. Okay. I'll go up to 20 cents. I'm in there. I'm trying to pay 20 cents for that spread.
There goes.
Right. So I filled. So now I'm in the game, right? I'm a beginner. I'm in the game for $20 with commissions. And this is realistic, right? I can go and say, look if we're this is a butterfly. Now,
Yep.
the thing that we didn't say, if you have the vertical spread on and it goes down, you're going to make some money.
Yes.
But the person who said to me, Dan, I only have $30 in my pocket. Can I play SPX? And we got you for $20. But here's the good, the bad, and the ugly.
Yes.
Look at the graph there. If Evil Knievel lands in that graph area,
Yes.
right, or is near the graph area, you're a contender. You're in good shape. And what is that range? So that range looks like it's roughly 6,900 to 6,910.
Yeah, right? Minus 20 points on each side. So you have almost a 10-point range that you need to kind of stick the landing.
It's kind of a bull. Yeah, it's, but I mean, you paid $30, right? So you're getting but to me, it'd be, as you're going there, if this thing were to finish, obviously near 6,905, this $20 can grow massively, right?
Yes.
In that range. So this is a little more fickle, right? You need a specific range on a butterfly, but this is just, I call these time bomb butterflies. You just plant them out there. They're out of the money. But again, this isn't that far out of the money. If you said, Dan, where would you like the stock to go? 6,905. Is that reasonable that SPX could go on 23 points? You bet your britches it is, right? Now, if you want to, as we say, open it up, take the governor off the mini bike, what do? Get rid of that credit spread on the bottom, Matt.
That's right. So if we get rid of the credit spread on the bottom, which is a 6,905 short put and a long put at 6,900, we're left back with that original spread, which is $130.
Yeah,
and the chat is asking some questions about this right now.
Yeah, if you're going down with the vertical spread, okay, you pay $1.25 for this. If we go down, you're going to get reward, right? You're going to get reward. Whereas the butterfly, you're only paying $20. You need more of a range.
Yes. And so one of the questions in the chat is, what's the real benefit with limited risk reward? Well, that is the benefit. It's a limited risk reward. If we back this out and just start from scratch, I go back to the chain, you can see how much these options for Monday cost.
Huge.
Right? And they're buying a naked option is expensive. So if we wanted to buy that 6,910 option, we're paying $1,200. We add in the 6,905, it's greatly smooths it out. Greatly smooths it.
Yeah, you're reducing your delta, you're reducing your risk, your exposure. And I think this is the way most, at least people I see, veteran traders, they're not just going in there and lugging a put, right? There's situations you would do that, right? I'm not saying there's not. I love to buy puts as hedges and stuff like that. But in terms of putting a position on, again, we're not saying we know Iran or geopolitical is going to blow up over this weekend. Probabilities probably won't, right? So if you bought that put for 1,200, we collapse Monday, you're happy. But if not, you're out 1,200 and you won't talk to me for a week.
Right?
So here you have some cheaper alternative. What I'm saying is cheaper alternatives for speculative trades. And you say, Dan, why do you want cheaper alternatives? Because the probabilities aren't in your favor, right? It's like you're going to Vegas. I mean, I don't want to compare that, but when you're going to Vegas, it's, do you have the probabilities in your favor? Now, some people will say yes. But anyway, so these are a couple in the most expensive vehicle out there.
Yeah.
We just showed that you can participate in some directional plays for 130 or 120 and $20, right? In realistic trades. I mean, now you could, one thing you could do on the butterfly.
Yeah.
If you want to, so let's set up the butterfly there.
Yeah. The other thing I was thinking, I can make it balanced, but I was thinking of also doing like some sort of maybe
That's
broken
exactly what I was
structure.
thinking.
Okay.
Yeah, just make it. Yeah. So we have this butterfly, and okay, you say, Dan, I like it. $30. I have a narrow range, but hey, $30, right? In
Yeah.
that range, that thing can go. I can make 800, 600% or whatever. But that's a speculative shot. But if you say,
That's
Dan,
right.
we could have a big move down.
Yeah. You
So
could do something
can we
like
open?
this.
Yeah, can we open up, take off the governor off the mini bike?
Yeah.
And that's what Matt did right there. Why don't you explain what you did, Matt?
Yeah. So instead of buying the 6910, I bought the 6915. So what that gives me is, because all butterfly is a debit spread and a credit spread together, right? So my debit spread is 10 wide. My credit spread is 5 wide. So what happens is we would still aim to pin this. That would be our biggest winner, would be pinning at 6905. But if we blow by, it's not like Evel Knievel where you need to stick the landing. We have downside exposure. So anything past that other strike of 6,900 is still going to be profitable. And that's where it's different than the balanced butterfly that we just looked at. Now, why would you not just do this every single time? Because it's more advantageous. Well, it's also 8 times as much money.
Yeah, and that's the answer.
So that's the reason.
Yeah, so you make, but that's the thing. Understand what the risk is.
Yeah.
Right? The butterfly was $20. $20,
Yeah.
right? Plus commissions. This is, you go from 20 to 160 or 160.
Yeah. And
now you can say, well, 160 is not much, but as Matt says, yeah, especially if you're doing more size, it is 8 times more money.
That's right. And the other thing you can do is you can validate your thought and say, hey, you guys are talking about a RAN and talking about a 20 or 30 point move. That's not enough. Say you wanted to model out a bigger move. Well, we could do something like putting the shorts at 68.50, for instance. If we put the shorts at 68.50 and move the longs to 68.75 and 68.30, we can get that same structure for a much different price. Now, let me see. I'm doing this live here, so I might need to. Yeah, there we go. All right, this is what we're looking at because we moved it down quite a bit. So in this case, we're still paying a price, but I made the tent much, much, much bigger, and I still have that downside potential. This is a cheaper fly than the one we just looked at. What's different about this? Well, this one has a 25 point wide debit spread. So the debit spread, which is the one resting closer to us, is 68.75 to 68.50. And then the credit spread beyond that is only 20 points wide. So it's still a broken structure. It's not a symmetrical structure. It's a broken structure. And you can see this wing here. If we would have a much bigger sell-off, which, just as a reminder to everybody, we were at 68.50. How many days ago, Dan? Yesterday?
Yes,
the day before? I mean,
right.
This is not that much farther away, and we're still only paying $120.
Yeah, and a couple quick things. Couple things to leave you with as we're kind of closing here. All we dealt with today was, folks, vertical debit spreads and vertical credit spreads.
Yes.
And you just have to get, you're used to say, Dan, I can't juggle one ball. You're throwing 2 balls. But you know what? As you see it, it's just we're combining these vertical debit spread, vertical credit spread. We went from a long put to a vertical put debit spread because it's cheaper. Then we added a vertical credit spread to a debit spread to make it even cheaper. And as you can see these things. Now, here's the other thing.
Yep.
Someone may say, you know what, Dan? I think it's going to take a little longer.
Yeah.
I don't think it's going to be Monday. I would like to make this bet to maybe next Friday.
No problem. We can change all these DTE to 7 DTE.
Yeah. So
and
now
we zoom back out and zoom back in and see the structure.
Yeah, and you can give it more time. But again, remember the butterfly, unless you break a wing, right?
Yes.
And what does break a wing mean? It just means one side is, when you take from the short strike to each of the long options, if they're both the same, that would be balanced.
That's
right. One of them's less than the other, that would be unbalanced or broken wing. But if I was going on next Friday, I might pay, I mean, again, the cheapest one is the balanced butterfly. But if you want to open it up, like Matt's doing, then yeah.
And one of the reasons I like the broken structure, now I moved this to Friday and right now it's broken. If I make this, and the cost is about 195. If I make this symmetrical to where both the credit spread and the debit spread are 25 wide, I have a bigger tent that I have to nail. But if you look at it, it's not that much cheaper. It's not. We're still at 115 bucks.
Yeah,
so that's why I like spending a little bit more money. And you have this, if you're right. And here's the other thing. This is
a little bit more, but just for reality.
Yeah, it is almost twice as much, I guess.
Yeah,
so it's more than a little bit more.
Yeah, we're dealing with small numbers, but you still have to remember, it's still about 80% more.
But if we change it back to 3 days, our difference in price is much closer. So if I go back to a 3-day, this is the broken structure here where I've got 25 points to the credit spread, debit spread, and 20 points to the credit spread. And it's 110 bucks. We're on Monday. Okay. If I change it, it goes from 110 down to 95. So from Monday, there's not a big price difference. Friday, there's a big price difference because we're paying for the extra time. And we have that exposure to the downside, but it costs money to buy that.
Yeah. So, one quick one. Someone might say, well, Dan, I get what you're saying a little bit today, but the biggest thing is, where do you place your short strike? Because that's the key here. What do you use for, where do you place your short strike? Yeah. I just, as a guideline to start, and Matt, we went over different stuff here. I like to start with maybe a 30 delta.
Okay.
Because at least a 30 delta, going back to Marlon Brando, it can be a contender. You say, why can a 30 delta be a contender? Because there's a concept called probability of touching, right? And a 30 delta is basically saying there's almost a 60% probability we could touch that short strike.
Yeah.
Right. So in other words, I could put it way out all the way to Missouri. Right. Yep. But it's not going there. Right. It's not, it's like saying, I think Tesla's going up 400 points tomorrow. Well, good luck to you. Right. But it's not. Right. Look at the delta of an option 400 points out of the money that expires tomorrow. Have a good time with that.
Pretty small delta.
Yeah, pretty small delta. But here, a 30 delta, now we're talking real here, right? There, this has got a really good shot. Now, again, if you want to go farther out of the money, it's always going to be cheaper.
That's right.
But you got to remember, cheaper, you go to dollar store, right? Let me ask you a question. When you go to the dollar store, how long does some of that stuff last? Sometimes.
That's right. Yeah. They're not getting the freshest mozzarella in the back in the freezer for $1. Like, it might have some green spots on it, Dan.
Yeah. Well, Matt, do you want anything you want to add to this?
No, I mean, it's just, I will just say this modeling options is so powerful because you can visualize it and you can test your theory and your thesis, and you can see, like in Dan's example, if you centered the short put at 20 delta and made it 5 wide from Monday, you can see that $75. If you thought, hey, the market's really underpricing this, I think it's going to happen, and you went crazy with like a 10 delta, well, then you can see, well, how much does that cost? Well, if I buy a 10 delta 5 wide, that's only going to cost me 30 delta, but it's a lot cheaper, but there's a lot lower chance of it happening. And then you can view that and say, okay, well, that 10 delta put, I need a big sell if I need 100 points for that thing to work, but it only costs you $30. Your max spread width is your max profits, $500. That'd be a 1,500% return if you're right all the way. So you can check your own filters for reality against the options pricing market and see if they think the same things that are going to happen as you do. So it's a very powerful thing. Yeah.
So folks, you've got some cheap, again, the myth buster today is, I can't play SPX for directional play. As Sylvester Stallone would say, absolutely you can. We've done everything we did here, right, Matt? Was I did a live trade at $20, and we'll check that on Monday. But I think the most expensive thing we hit maybe 180, 185. And these are all in the game. I mean, these aren't just like, we bet that SPX is going to drop 1,000 points. No. We're talking stuff that you just need a 30-point move or 25-point move down. So we'll look at some of these. I may even, Matt, maybe did you save any of these models? We can relook at them on.
I didn't, but I can
Maybe
make
pick a couple of.
I'll make a model and send
Yeah,
it
make
to
a
you.
model, and then you know what we'll do, folks? We'll check on a couple of Matt's
Sure.
models on Monday. I did a live trade. I may do one more, and if I do, and we can look back at those. But again, you're a beginner. Keep your range bound trades. To me, $400 or $500 keep or reasonable. But again, these are directional plays that were less than 150 or something. So, folks, hope review that. This will be up for the recording.
Yes.
Again, the more, even as a beginner, the more you watch it, the more you look at graphs, the more you review this, the light bulb will go off, right? And you say, how do you know? Because that's how it was with me. I would just look at graphs and go over. And after a while, you'll get used to it. So hang in there. Matt, thanks as always for driving the ship. You're the best captain in the business.
Well, thanks guys for tuning in. And as always, as Dan said, these shows are on YouTube, so feel free to come back and check them out. And we have, if you want to chop up more advanced concepts, we've got 3 or 4 other shows, and we do the OO show every market morning at 8:45. So,
hey, Matt, if somebody saw the modeling tool here and they said, "Hey, Matt, where can I get it? About what is it called?
You can optionomega.com. We've got you can subscribe to just this modeling tool. We're probably most known for our automation and backtesting, but you can get any combination of backtesting, modeling, and automation that you want. So if you want to check it out, it's $30 a month just to start with a month of modeling. And like I said, we got monthly and annual, tons of choices. Hit us up if you have any questions.